While everyone's focused on holiday sales and year-end celebrations, a $52 billion situation is quietly unfolding in commodity markets. By the time most people realize what's happening, the opportunity to understand or prepare for it will have already passed. What I'm about to share involves mathematics, market structure, and a calendar-driven event that occurs once per year. But this year, the conditions are unlike anything we've seen in over a decade. Tomorrow marks the beginning of what traders call the Ghost Week. It's a 10-day period when financial markets technically remain open, but the people who make those markets function essentially disappear. Investment bank trading desks close. Hedge fund managers take vacation. Market makers who normally provide liquidity step away from their screens. Trading volume can drop by 70% or more. Here's what makes this year different. Silver just closed at 80 for Queen per ounce on Christmas Day. Right now, there are 145,000 futures contracts sitting in the March 2026 delivery window. Each contract represents 5,000 ounces of silver. Do that multiplication with me. That's 725 million ounces of silver exposure, worth approximately 52 billion frozen in place while the market enters this liquidity blackout. Let me explain why this matters using a real-world example. Imagine managing a solar panel manufacturing facility. Your production line requires 50 kilos of silver every single day. Silver isn't optional in solar panels. Its unique electrical conductivity properties make it irreplaceable for converting sunlight into electricity. Your procurement team typically buys futures contracts months in advance to lock in prices and protect against volatility. Standard business practice. But what happens when the people who normally sell you those contracts aren't there? When the market makers are on vacation? When institutional desks are closed? When liquidity providers have stepped away for the holidays? You're left with an obligation to deliver products to your customers, but no stable market to secure your raw materials. Now multiply that scenario across hundreds of industrial users. Solar manufacturers in China, India, and the United States. Automotive companies building electric vehicles with silver-intensive electrical systems. Electronics manufacturers producing everything from smartphones to medical devices. They all need silver, and they all face the same liquidity drought starting tomorrow. According to data from the CME Group, silver futures open interest has been climbing steadily since September 2025. This isn't random. This represents real positioning by real companies with real manufacturing obligations coming due in February and March. When November 22nd, 2025 arrived, the March 2026 contract became the primary trading vehicle. Every new hedge, every industrial purchase, every speculative position started flowing into this single contract window. And that window converges exactly with the worst liquidity conditions of the entire calendar year. If you're finding this information valuable so far, consider subscribing to stay updated on market analysis like this. It really helps the channel continue producing this type of content. This is educational content only and should not be considered financial advice. Always consult with a qualified financial professional before making any investment decisions. We need to talk about the timeline chain reaction that's about to unfold. Markets closed yesterday for Christmas. Today is December 26th. Boxing Day, meaning London, Hong Kong, and Singapore markets are closed. Then we hit the weekend. December 30th and 31st, we'll see skeleton crews at best. With New Year's Eve festivities shutting down, what little activity remains. January 1st, 2026, global markets close for New Year's Day. We won't see anything resembling normal liquidity until January 2nd, at the earliest, possibly January 5th. Realistically, that's 10 full days of effectively frozen markets, while industrial demand continues uninterrupted. Before we continue, I want to be clear about something important. This analysis is for educational purposes only. I'm not a financial advisor, and nothing in this video constitutes financial advice. You should always do your own research and consult with qualified professionals before making any investment or business decisions. The markets involve substantial risk and you could lose money. This disclaimer applies to everything discussed in this video. Now, let's examine why those 145,000 contracts aren't just paper abstractions. They represent real metal that real companies desperately need for manufacturing that cannot stop. Industrial silver demand hit a record 685 million ounces in 2024. That's not marginally higher than previous years. According to the Silver Institute's World Silver Survey, this represents the highest industrial consumption level in recorded history. To put that number in context, total global silver mining production across all countries combined produced only 813 million ounces in 2024. Let me do that subtraction for you. We mined 813 million ounces. Industry consumed 685 million ounces. That leaves only 132, 5 million ounces for everything else. Jewelry, investment demand, coins, medical applications, and the strategic reserves various governments are now building since silver became a United States critical mineral. But here's where the mathematics becomes genuinely concerning. Industrial demand isn't some stable baseline, It's accelerating because of one technology shift that's consuming silver at rates nobody predicted even 5 years ago. Solar photovoltaic manufacturing alone consumed over 200 million ounces of silver in 2024. That's more than 30% of total industrial demand flowing into a single application. Think about what that means. One industry, solar panels, is now consuming a quarter of all the silver humanity pulls from the ground each year, and that number is projected to grow substantially. The solar industry has shifted to something called TOPCon technology, tunnel oxide, passivated contact cells, if you want the technical name. What matters for our silver discussion is this. TOPCon panels require 50% more silver than the previous generation of PERC technology. Not 5% more, not 10% more, 50% more silver per panel. According to projections from the International Energy Agency and multiple solar industry analysts, the global solar sector is projected to demand between 10,000 and 14,000 tons of silver annually by 2030. Let me convert that to the same units we've been using. 14,000 tons equals approximately 450 million ounces from a single industry. Remember our total global supply number, 813 million ounces from all mining worldwide. If solar demand hits the upper projection of 450 million ounces, while other industrial applications continue at current rates, we're looking at total industrial consumption exceeding 900 million ounces, more than 100% of global mine production, before we've allocated a single ounce to jewelry, coins, or investment demand. Here's what makes the supply situation even more constrained. Most silver isn't mined from dedicated silver mines. Approximately 70% of silver comes as a byproduct of copper, lead, and zinc mining. When copper miners operate their facilities, silver comes along for the ride. But copper miners aren't going to accelerate production simply because silver prices are elevated. They make decisions based on copper economics. Silver is just a bonus revenue stream. The Silver Institute data confirms this reality. Global silver mine production growth has averaged less than 1% annually over the past decade. Meanwhile, industrial demand has grown by 15% over the same period, with acceleration expected through 2030. Supply growing at 1% annually. Demand growing at 15%. You don't need an economics degree to understand where that mathematical divergence leads. This brings us to perhaps the most important revelation. The silver market has recorded deficits for 7 consecutive years. Not surpluses, not balanced supply and demand. 7 straight years where the world consumed more silver than it produced. The 2020-84 deficit alone reached 148, 9 million ounces according to compiled industry data. That's nearly 20% of annual mine production, simply disappearing from available supply. Add up the deficits from 2021 through 2024. The total comes to approximately 688 million ounces. That's equivalent to 10 months of global mine production, nearly a year's worth of mining output that's been pulled from inventories, ETF holdings, government stockpiles, and recycling flows to make up the shortfall between what we mine and what we consume. Here's the question nobody in mainstream financial media seems to be asking. Where is that 678 million ounces coming from? When demand exceeds supply for 7 consecutive years, you're drawing down stored inventory. But inventory isn't infinite. Eventually, you reach the point where there's nothing left to draw down. According to the CPM Group and the Silver Institute, identifiable above-ground silver inventories have been declining. Silver-backed exchange traded products absorbed 95 million ounces in just the first half of 2025 alone. That's investment demand competing directly with industrial users for the same finite supply. Think about the mechanics of what's happening. A solar panel manufacturer in California needs silver to make panels. An investor in New York wants silver as an inflation hedge. An automotive company in Michigan needs silver for electrical systems and new vehicles. They're all competing for ounces from the same 813 million ounce annual supply. And that supply hasn't grown in 8 years, while demand has surged by double digits. Economic theory tells us what happens in this scenario. Price rises until demand is destroyed or new supply is created. But we've already established that new supply can't materialize quickly because of the byproduct nature of silver mining. So the entire burden of rebalancing this market falls on demand destruction through higher prices. How high do prices need to rise to destroy industrial demand for silver? That's the critical question. Can a solar manufacturer simply decide not to use silver and substitute cheaper materials? The technical answer is not easily, and not without completely redesigning panel architecture, which takes years and billions in research and development investment. Can automotive companies eliminate silver from electrical systems? Not when silver is the most electrically conductive metal available at commercial scale, and modern vehicles require increasingly complex electrical architectures for safety systems, battery management, and autonomous driving features. Can medical device manufacturers stop using silver and antimicrobial applications? Not when silver's unique properties make it irreplaceable for certain critical health applications. The brutal reality is that industrial silver demand is remarkably inelastic. That means it doesn't decrease much even when prices rise substantially. If you're still with me, hit that like button. It tells YouTube to show this analysis to more people who might benefit from understanding these market dynamics. A solar company might grumble about paying higher prices instead of lower ones, but if they need the metal to fulfill panel orders worth millions of dollars, they pay the price. The silver cost, even at elevated levels, is still a small fraction of the total panel manufacturing cost. This inelasticity is precisely what creates the conditions for price explosions during liquidity crunches. When buyers can't delay purchases because manufacturing schedules are locked in, and when sellers vanish because liquidity has evaporated, the market has no mechanism for orderly price discovery. It just gaps violently, suddenly, irreversibly. We saw hints of this dynamic in the late December price action. UBS strategists didn't call the market unhinged casually. They were observing price behavior that had decoupled from normal supply-demand fundamentals, driven instead by positioning and liquidity constraints. Analysis confirms the mechanism. With global markets closed and meaningful volume absent, even modest buy pressure triggers disproportionate moves. Scale that up to the first week of January when months of deferred purchasing meets the reopening of futures markets. And you can see the mathematical setup for a significant price movement. Here's the institutional positioning paradox that makes this even more dangerous. When markets are functioning normally with healthy liquidity, large institutional players can manage their positions strategically, adding here, trimming there, rolling forward, adjusting exposure. They have options, they have time, they have counterparties willing to take the other side of their trades. But during the ghost week, all those mechanisms break down. If you are holding a short position in March 2026 silver futures and you want to close it out to limit risk, who's going to take the other side when the market makers are on vacation? If you're a commercial hedger who needs to roll forward your exposure from March to May contracts, where is the liquidity to execute that roll without massive slippage? The answer is it's not there. The liquidity simply doesn't exist during this 10-day window. So institutions have two choices. Either they positioned themselves before the ghost week began and they're locked in for the ride, or they're going to pay whatever price is necessary to adjust when markets reopen. Based on the record open interest in silver futures heading into this holiday period, it appears many players chose option one, lock in positions and hope for the best. That's 145,000 contracts representing billions of dollars in notional exposure frozen in place while the market enters suspended animation. Think about this from the perspective of someone managing a corporate hedging program. You're the procurement director for a major electronics manufacturer. Your company uses 500,000 ounces of silver per month in production. Back in November, you hedged your February and March needs by buying futures contracts at a certain price level seemed prudent at the time. Sound risk management. Now it's December 26th, and you're watching the market enter the liquidity blackout. Your hedges are in place, but you can't adjust them. You can't monetize gains if prices move in your favor. You can't add protection if prices move against you. The market structure won't let you. You're simply locked in until normal trading resumes. Multiply this scenario across dozens of industrial users, hundreds of trading desks, thousands of individual futures positions, and you begin to understand why the March 2026 contract has become such a pressure cooker. Everyone's locked in, nobody can adjust, and the only relief valve, market liquidity, doesn't return until January on 2nd at the earliest. The 7-year deficit story we discussed earlier isn't ancient history. It's the foundation beneath current price action. Every ounce of that 678 million ounce cumulative deficit had to come from somewhere. It came from drawdowns and ETF holdings, melting of old jewelry and coins, releases from government stockpiles, and depletion of commercial inventories. According to data from the World Silver Survey, identifiable silver inventories in exchanges, ETFs, and depositories have been trending downward even as prices have risen. This is the opposite of what economic theory predicts. Normally, rising prices should bring more supply to market. Higher prices incentivize more production, more recycling, more selling. But we're not seeing that because the supply simply isn't available to bring to market at any price in the short term. When inventory drawdowns can no longer fill the gap between production and consumption, the only equilibrium mechanism left is price. Not gradual price increases that allow demand to adjust smoothly, but violent price discovery that forces immediate market clearing. We're about to find out whether current price levels are sufficient to meaningfully reduce industrial demand and rebalance this market. My reading of the data suggests it's not even close. Solar installations aren't slowing down. They're accelerating globally due to climate commitments and government subsidies. Automotive electrical systems aren't getting simpler. They're getting more complex with every model year. Medical applications aren't declining, they're expanding as populations age and healthcare technology advances. So, if current prices aren't high enough to meaningfully reduce industrial demand, and if mine production can't increase significantly on any relevant time frame, where does the market clear? At what price point does equilibrium finally occur? That's the calculation waiting to be made when liquidity returns in January. And with 145,000 futures contracts sitting in the March 2026 window, all representing buyers who need metal or speculators positioned for various outcomes, the mathematical resolution isn't a mystery. It's an inevitability wrapped in a calendar-driven liquidity crisis, backed by 7 years of structural deficits, amplified by record industrial demand that cannot easily be reduced and triggered by the single worst liquidity window of the entire year. The Ghost Week isn't creating this crisis. It's just removing the mask that's been hiding how severe the supply-demand imbalance already is. When markets reopen in early January, every industrial buyer who delayed purchases during the holiday blackout will face a binary choice: accept whatever price the market demands or risk missing physical delivery obligations for their February and March production schedules. There's no third option. You can't manufacture solar panels without silver. You can't delay automotive electrical systems. You can't tell your customers to wait until prices improve. Let's talk about what this means in practical terms. We're starting from the current base price. Technical analysts have identified clear resistance levels based on chart patterns and historical price action. In normal market conditions with healthy liquidity, moving through these resistance levels might take weeks or months as buyers and sellers negotiate price discovery through millions of small transactions. But these aren't normal conditions. The next meaningful resistance level appears at round number psychology points that consistently matter in commodities markets. From our starting point, that represents a significant percentage gain. Let me show you what that percentage means when multiplied across 145,000 futures contracts. Each silver futures contract represents 5,000 ounces. So 145,000 contracts equals 725 million ounces of notional silver exposure. At current prices, that's tens of billions in total notional value. A substantial move higher increases that notional value by billions of dollars. Now, here's the critical insight. Most people miss well that multi-billion-dollar increase doesn't just sit as unrealized profit or loss on some accounting ledger. In futures markets, daily price movements trigger margin calls, actual cash that must be deposited with brokers by the close of the next trading day. When silver gaps higher substantially in a matter of days or hours, every short position holder, every commercial hedger on the wrong side, every speculator who bet on mean reversion, they all face immediate margin requirements totaling billions of dollars. What happens when billions in margin calls hit during the first week of January, right? As liquidity is just starting to return but remains thin, you get forced liquidation. Traders who can't meet margin calls must close positions at market prices, regardless of how unfavorable those prices are. And in a thin market, forced buying creates a feedback loop. Buying pushes prices higher, which triggers more margin calls, which forces more buying, which pushes prices even higher. This is the squeeze mechanism in its purest form. It's not manipulation, it's not conspiracy. It's mathematics meeting market structure under conditions of extreme liquidity stress. According to positioning data available through the CFTC's Commitments of Traders reports, managed money, the category that includes hedge funds and large speculators, hold substantial long positions in silver futures. But the commercial category, which includes mining companies, industrial users, and banks providing hedging services, shows significant short exposure. Those commercial shorts made perfect sense when they were placed. A mining company that knows it will produce 1 million ounces of silver over the next 6 months naturally hedges by selling futures contracts to lock in prices. An industrial buyer who owns silver inventory hedges by shorting futures to protect against price declines. A bank providing hedging services to clients takes the opposite side of customer trades. All perfectly rational hedging behavior in normal markets. But when that market enters a liquidity blackout at elevated price levels with record open interest, those safe hedges become potential liabilities worth billions. Think about the timeline we're facing. December 26th, liquidity disappears. December 27th through 29th, weekend, virtually no trading. December 30th and 31st, skeleton crews, year-end book squaring, minimal volume. January 1st, global holiday, markets closed. January 2nd, markets nominally reopen. But with many traders still on vacation, true liquidity won't return until January 5th or even January 6th when everyone's back at their desks. 10 full days where the price discovery mechanism is essentially frozen. But industrial demand isn't frozen. Solar panel factories in China, India, and the United States continue operating through the holidays. Automotive production lines keep running. Electronics manufacturing doesn't stop for Christmas. According to manufacturing industry data, Many facilities actually accelerate production in late December and early January to meet quarterly targets and clear order backlogs before fiscal year-end reporting. These companies need physical silver delivered to their facilities, and they need it on schedules that don't care about market holidays. When these industrial buyers return to the futures market on January the 2nd or 3rd to execute the purchases they delayed during the liquidity drought, what price will they find? Whatever price the market demands, because there's no alternative source of immediate supply. Physical silver doesn't materialize from thin air. It has to be mined, refined, transported, and delivered. Processes that take weeks or months, not days. The March 2026 futures contract became the front-month trading vehicle on November 22nd, 2025. That means every new position, every roll forward from December contracts, every industrial hedging transaction, it's all flowing into March 2026 contracts. And March delivery is only 2 months away from when markets reopen in January. 2 months sounds like plenty of time until you consider the logistics of physical delivery. If you're a futures holder who wants to take physical delivery, you need to provide notice, arrange for vault storage or transportation, coordinate with refiners and logistics companies, and execute payment transfers. These processes require advanced planning measured in weeks, not days. According to CME Group delivery procedures, participants must provide notice of intent to deliver or take delivery well before contract expiration. As we get closer to March 2026, the window for orderly delivery arrangements narrows. Industrial buyers who genuinely need metal cannot wait until the last minute. They need to secure their positions in January to ensure February and March delivery. This creates a binary forcing mechanism. Either industrial buyers pay whatever price is necessary to secure March contracts in early January, or they risk not having metal for spring production schedules. There's no middle ground. You can't manufacture solar panels with promises of future silver deliveries. You need actual metal on actual production lines. Now, let's talk about the catalyst that transforms silver from just another commodity into a strategic national priority. In 2025, silver was designated a United States critical mineral. This isn't symbolic classification. It's formal recognition that silver is essential to economic and national security with supply chains vulnerable to disruption. According to the U.S. Geological Survey, critical mineral designation triggers several policy mechanisms: preferential permitting for domestic mining projects, inclusion in strategic stockpiling considerations, trade policy protections, enhanced monitoring of supply security. While we don't have public data on strategic silver stockpiling volumes, the very fact that government procurement could enter the market as an additional demand source adds another layer of pressure to already tight supply-demand dynamics. Think about what critical mineral status means in practical terms. The U.S. government is explicitly acknowledging that silver supply is crucial to national interests. Solar panels for the renewable energy transition need silver. Defense electronics and military hardware need silver. Medical devices and hospital equipment need silver. 5G telecommunications infrastructure needs silver. When a commodity becomes this strategically important, price becomes secondary to security of supply. If a government agency determines that domestic stockpiles need to increase for national security reasons, they buy at market prices regardless of where silver is trading. The strategic calculation overrides the financial calculation. This adds yet another category of potentially inelastic demand on top of the industrial demand we've already discussed. And remember, global silver mining produces only 813 million ounces annually, a number that hasn't meaningfully increased since 2016, despite dramatic price appreciation over the past year. Here's the supply-side reality that nobody can engineer around. You cannot increase silver mine production quickly. Even if silver prices rise substantially and mining becomes incredibly profitable, it takes 5 to 7 years to develop a new mine from discovery to production. You need geological surveys, environmental permits, infrastructure development, equipment procurement, hiring and training workers, and construction of processing facilities. According to S&P Global Market Intelligence data on mining project timelines, the average greenfield mining project requires 6 and 1.2 years from final investment decision to first production. That's assuming you already have a discovered deposit, completed feasibility studies, and secured permits, all of which can add years to the front end of the timeline. So, if silver prices surge in January 2026, when does new supply arrive to rebalance the market? Not in 2027, not in 2028, potentially, not until 2031 or 2032 if we're starting new projects from scratch today. And that's assuming high prices persist long enough to justify the billions in capital investment required for new mines, and assuming those projects don't face regulatory delays, environmental challenges, or local community opposition. This is why the supply-demand gap cannot be filled by increased production in any relevant time frame. The market has to clear through the only mechanism available, price rising until demand is destroyed or substitution occurs. But, as we've established, Industrial silver demand is remarkably hard to destroy through price increases alone. Solar panel manufacturers are locked into technology roadmaps developed years ago with billions already invested in TOPCon production facilities. They can't simply switch to silver-free panels. The technology doesn't exist at commercial scale. They pay the higher silver price, or they shut down production lines. And shutting down means defaulting on customer contracts worth far more than the incremental silver cost. Automotive companies are in similar positions. Modern vehicles require sophisticated electrical architectures that depend on silver's unique conductivity properties. Redesigning electrical systems to eliminate silver would require years of engineering work and billions in retooling costs. It's cheaper to pay elevated silver prices than to re-engineer entire vehicle platforms. This is what creates the mathematical certainty of the squeeze scenario. When supply is fixed, when demand is inelastic, when inventory buffers have been drawn down over 7 consecutive years of deficits, the only variable left is price. And in a market experiencing a liquidity crisis during the worst trading window of the year, price doesn't adjust gradually. It gaps violently to whatever level is required to achieve temporary equilibrium. Let's run through a plausible scenario that becomes increasingly probable the more we examine the data. Markets reopen January 2nd after the 10-day liquidity blackout. Industrial buyers who deferred purchases during the holiday period immediately enter the market to secure March 2026 contracts for spring delivery. Hedge funds and managed money players who wrote earlier price momentum see continuation and add to long positions. Meanwhile, commercial shorts, who were comfortable with their hedges at lower price levels, suddenly face margin calls as prices push toward technical resistance. Some can meet the calls, but others, particularly smaller participants or those with leveraged positions, are forced to buy back their shorts to close positions. That buying pressure pushes prices through initial resistance levels. As resistance breaks, technical traders watching charts see a breakout signal. Algorithmic trading systems programmed to follow momentum trigger additional buy orders. Now prices are climbing rapidly. The commercial shorts, still holding on, face larger and larger margin calls. More forced buying ensues, major psychological price levels break. At this point, we've moved substantially from the Christmas Day close, but here's the uncomfortable question. Why would it stop there? If the fundamental supply-demand imbalance hasn't been resolved, if industrial buyers still need metal, if inventories remain depleted, if mine production hasn't magically increased, what mechanism prevents price from continuing higher? In a short squeeze, price doesn't stop at logical resistance levels. It stops when shorts are completely liquidated or when new supply emerges, whichever comes first. We know new mine supply isn't coming for years. So, price runs until shorts capitulate entirely or until industrial buyers start canceling orders because silver has become prohibitively expensive. At what price does a solar company cancel billion-dollar panel contracts? At what price does an automotive manufacturer delay new vehicle launches? Those are the real resistance levels, the pain thresholds where demand finally breaks. Nobody knows exactly where those thresholds are because we've never tested them at these supply-demand fundamentals. Earlier, silver price spikes occurred under different circumstances. Previous rallies were primarily investment-driven bubbles. This time, it's industrial demand colliding with structural supply deficits during a liquidity crisis. The dynamics are fundamentally different. The historical record shows us what happens when industrial commodities face this combination of factors. Palladium spiked from $500 to $3,000 per ounce between 2016 and 2020 because automotive demand for catalytic converters exceeded mine supply. Lithium carbonate surged from $6,000 to $80,000 per ton in 2022 as battery demand outstripped production capacity. In both cases, prices didn't gradually appreciate. They exploded higher in month-long rallies that caught most market participants completely off guard. Silver is setting up for a similar dynamic, except with far less warning time due to the liquidity crisis compressing the timeline. Instead of a rally measured in quarters or years, we might see substantial price movement compressed into days or weeks. Before we wrap up, if you found this analysis helpful, make sure you're subscribed and have notifications turned on. Market conditions like this don't come around often, and understanding the mechanics can make all the difference. Here's what individuals watching the situation need to understand. The liquidity blackout begins December 26th, tomorrow. By the time you're seeing this, the trap may have already sprung. The market has entered or is about to enter the ghost week. The 145,000 contracts representing 725 million ounces and tens of billions in notional value are frozen in place. When markets reopen January the 2nd or 3rd, the price you see at the opening bell could be dramatically different from the Christmas Day close. Futures markets are allowed to gap. There is no requirement for continuous price discovery. If enough buy orders accumulate during the closure period, the market can simply open significantly higher with no trades in between. For those holding long positions in silver, whether futures contracts, mining stocks, or physical metal, this represents the scenario many have been positioned for. The mathematical setup is about as clear as it gets. Structurally tight fundamentals meeting a predictable liquidity crisis at elevated price levels with unprecedented open interest. For those holding short positions or operating without hedges, the next 2 weeks represent existential risk. You cannot adjust positions during the ghost week. You cannot add margin if your broker calls. You cannot close out losing trades in an orderly fashion. You're locked in until liquidity returns. And when it returns, you face whatever price the market demands. For industrial users who need physical silver for production, this is the moment to examine your supply chain and hedging strategies with complete honesty. If you're counting on spot market purchases in January or February to meet spring production needs, you're betting that this analysis is wrong. You're betting that somehow the supply-demand imbalance will resolve itself, that liquidity will return smoothly, that prices will remain stable despite all the evidence suggesting otherwise. That's not a hedge, that's hope. And hope is not a strategy when you're facing mathematical certainty. The potential squeeze isn't a prediction about what might happen if various factors align perfectly. It's an observation about what happens when you combine 7 years of structural supply deficits, record industrial demand that cannot easily be reduced, 145,000 futures contracts locked into a tight delivery window, critical mineral designation adding strategic demand, and the worst liquidity conditions of the entire calendar year. The math is straightforward. The setup is clear. The catalyst is guaranteed by the calendar. And the outcome, when billions in forced buying meets thin liquidity and tight supply, has only one direction to resolve. The ghost week begins tomorrow. The squeeze mechanism is already locked in. When markets reopen in January and everyone's asking, how did silver move so dramatically so quickly? The answer will be obvious to anyone who was paying attention to the mathematics. Because in markets, when liquidity disappears and obligations remain, price doesn't negotiate. It simply discovers what level is required to clear the imbalance. And with 145,000 contracts, 148 9 million ounces of annual deficit, and 10 days of frozen price discovery, that level is mathematically likely to be substantially different from where we closed on Christmas Day. The only question left is whether you are positioned for what's mathematically probable or whether you're hoping the math is somehow wrong. By January 2nd, we'll all know the answer. The data will speak for itself. Until then, stay informed, stay critical, and remember that understanding market mechanics is always more valuable than hoping for the best. This has been an educational analysis of silver market structure during a unique liquidity event. Thanks for watching, and I'll see you in the next